Today is Monday, February 13th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, the Senior Financial Economist. Alan, on Friday a report showed that China's January trade data blew past expectations, with exports climbing nearly 8% and imports soaring upward to 16.7%, which was the highest level since January of last year. Do you believe these numbers, and if so, do you believe these type statistics for China can be sustained?
Well, I do believe the numbers, and one reason that I do think that they are good numbers is that we have seen bank lending in China increasing at near record rates, presumably for companies to expand. So I believe that China will probably have a GDP of 6.8% or better, and I would also anticipate that these numbers will be sustained, so the Chinese economy is not going to fall off the edge as many had predicted last year. It will hold up, I think, rather well.
And let's talk about copper, one of the most industrial of metals. Last week, the futures advanced to a 21-month high. Is this strength due to supply disruptions, or are there other factors here?
Well, it's a combination of the two. There are some supply disruptions. In fact, we did see a new high today with good gains there. But I also think that and this goes in hand with what we're looking for in China and globally, the economy globally is improving. And I think that's a good part of the reason for the strength in the copper and industrial metals overall, including iron. Iron ore is at some new highs as well. So it's a sign that the global economy is improving and is likely to have good gains this year, and I think well into next year.
Staying with the metals for a minute and the gold market, in light of the bearish influence of expectations of tighter credit from the Fed and recent strength of the U.S. dollar, what is the outlook for gold futures now?
Well, the gold had a really nice rally in about a 9-day period. It rallied about $65. It's given some back over the last couple of days, and the reason is I think that many traders are liquidating assets of various types just so they can buy equities and try to get on board with the bull market and stock index futures. But ultimately, the precious metals will be rescued by the inflation outlook, which is likely to continue to expand as far as inflationary numbers. So I would buy any break around the 12.15 area in the April contract, and I do believe this is just the beginning of a long-term bull market that we are going to see, not just in the gold, but also in the silver.
Steve, soybeans. The March contract continues in a price uptrend, really since last August. Last week, however, they ran into some resistance near the 1060 level, and the funds keep adding to long positions despite record world supplies. Why are they buying, and do you feel the rally will continue?
I think they're buying it because of the demand. You know, we see China buying soybeans almost every week. They come in and buy futures, and with the U.S. and Brazil farmer reluctant seller, or maybe the U.S. farmer is already sold out of his 2016 supplies, there's not a lot of overhead resistance. So the combination of the China buying and the lack of farmers selling is encouraging the funds to add to their longs. Do I think it's going to continue? It shouldn't, because the supply is just too big.
Flipping to corn, we have also seen a bit of an uptrend here since the early September low of 325. Last week, the corn traded over the 200 moving day average near 367. Again, we have record world supplies and concern over trade issues and biofuel mandates. Will the rally continue, or is this a selling opportunity?
The funds, since the low, have added 220,000 contracts, and the open interest has gone up. So I think that the trend will continue. It has a lot of headwinds with the farmers having a record supply, but I think the fact that there will be lower acres in the U.S. and the fact that there's a little uncertainty on the weather will continue to allow corn futures to gradually move higher.
And let's touch on the wheat market. It looks like the winter wheat acres are going to be the lowest in over 100 years. The Chicago wheat futures have rallied from 392 to 450 and are testing the 200-day moving average for the first time since June. World wheat supplies are record high and funds are still large net shorts in the market. Do you think this rally can continue?
You know, I think you have to flip a coin on this one because you'll need a weather problem to rally. There has been some concern about Russia and Ukraine escalating some tension and maybe reducing exports out of there. Russia's the #1 exporter of wheat now in the world. And there is some talk of some dryness this summer, especially across the southern plains. Last week we had record high temperatures for parts of Kansas, Oklahoma, and Texas. So I think that the funds really need to see a realistic weather problem to cover their shorts, and we're about 30 days away from that.
Finally, Steve, next week the USDA will have their annual Outlook Conference. Are you expecting any surprises out of the conference? What is the market looking for in regard to the first unofficial estimate of 2017 and 18 corn, soybeans, and wheat carryout?
Well, it'll be interesting because it's the first time they've had a conference without a Secretary of Agriculture. They don't even have any hearings planned on approving the appointee. And so it would be interesting to see what they say about number one, policy, number two, trade issues, and how that's going to impact maybe some of the long-term export outlook. And then number three, I think you have a wide range of guesses. There's soybean carryout estimates as low as 290 and as high as 650. For corn, it's low as 2 billion, as high as 2.6 billion, and a lot of that has to do with what kind of yield you're going to plug in for next year. The wheat carryouts are around 1 billion bushels. That's not going to change too much because what we're losing in acres, we might be losing in exports if the rest of the world has a normal supply. So it's going to be kind of interesting to see what they say next week. I doubt if it's a market factor, but it could give us the base for the 17 crops.
I guess I would ask them, what else is hot and what is not? Are there geopolitical concerns we should be aware of right now that could change any of the trends in the market?
I saw in Modern Trader this month, they had a poll of analysts, and they were talking about, at the end of 17, what would be the president's approval rating? And the majority of it was below 50%. But at the same time, they look at the Michigan consumer confidence level and sentiment level, and it's all, the majority is above 100%. So can the president come through with tax reform? Can he come through with a stimulus? And can he make America safer with more jobs? And that should continue to push equities higher, and that could offer some support to commodities in general. So a lot of factors, I think, dependent upon how successful the president is in with his new policies.
Well, I would have to add that the North Korea issue is back in the limelight again. Also, we have financial problems potentially in Greece coming back. So yes, there are some geopolitical issues that are with us, all of which, though, once again, should be viewed as supportive to the gold and silver. So just another reason why we like gold and silver so much at this point.
Remember, the views and opinions expressed here today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.